Will come to order. Today, our economy is growing because of the American Rescue Plan and the Biden-Harris administration's leadership. We're putting shots in arms and money in pockets. Families have a little bit extra to help pay the bills. Beginning today, July 15th, most parents will see a $250 or $300 monthly payment in their bank account for each child. In my state, 92% of children are eligible. Small businesses are reopening their doors. Workers are safely going back to work, often at higher wages. Last month, we added 850,000 jobs to the economy. Since President Biden took office, we've gained 3 million jobs more than in the first 5 months of any presidency in modern history. It's not only the jobs numbers, it's the quality of these jobs. For the first time in decades, workers are starting to gain some power in our economy, the power to negotiate higher wages, the power to get better working conditions, the power to have more control over their schedules and stronger benefits and more opportunities for career advancement. The Washington Post reported in the past 3 months, rank and file employees have seen some of the fastest wage growth since the early 1980s. Think about that. The fastest wage growth since Ronald Reagan said it was morning in America. That's what happens when we invest in our greatest asset, the American people. Instead of hoping money trickles down from large corporations, it never does, and pretty much every senator sitting on both sides of the aisle here knows that. We invested directly in our workers and our small businesses in our communities. When workers win, our economy wins. When everyone, as one of Senator Smith's predecessors used to say, when everyone does better, everyone does better. Chair Powell, you said the Fed can help make the economy work for everyone by ensuring a strong and competitive labor market, one where everyone can get a job, one where employers actually compete for workers. I agree. Those efforts, combined with President Biden's recent actions to increase competitiveness, are increasing worker power in the economy. We must build on this progress with investment in infrastructure that creates millions of jobs, increases our economic competitiveness, spurs growth in communities of all sizes all over the country. I've been all over my state in the past few weeks, talking with local leaders, seeing mayors in both parties in big cities and small towns. I've heard the same thing from all of them. They need more investment in infrastructure, like housing and transit, to build a stronger local economy. These are the places often overlooked or, worse, preyed on by large corporations and Wall Street banks. Many of these communities have watched for decades as investment has dried up, as storefronts have emptied. Companies close down factories and move good-paying union jobs abroad, from Pennsylvania and Ohio, 2 states especially. Private equity firms, big investors buy up the houses and jack up the rent. Small businesses struggle to compete against big box chains. Big banks buy up smaller ones only to close branches, leaving check cashers and payday lenders as families' only options. Think about the opportunity and growth we could unleash in this country if we gave these communities the investment to fulfill that potential. Of course, we know what happens whenever the economy starts to grow. The largest corporations, the biggest banks, throw all their efforts and their resources in finding ways to direct those gains to themselves. Last year, during a global pandemic and deep recession, CEOs paid themselves 299 times what their average worker made. An even bigger gap than before the pandemic. Now imagine the kind of windfall they'll try to rake in during this boom. We've seen it over and over. Consumers spend, driving up revenue for companies. They spend it on stock buybacks while complaining about workers demanding higher wages. Big banks rake in cash. They spend it on executive compensation and dividends and buybacks, and the Fed has usually allowed them to, Mr. Chairman, instead of lending in communities or increasing capital to reduce risk. The Fed should be fighting this trend, protecting our progress from Wall Street greed and recklessness, not making it worse. During your tenure, Chair Powell, the Fed has rolled back important safeguards, making it easier for the big banks to pump up the price of their stock and boost their already enormous power in our economy. Wall Street would have you believe that removing those protections has increased lending and supported the real economy. We've been assured that the banks have plenty of capital to withstand a crisis. But during the pandemic, it was community banks and credit unions, not the mega banks, that increased lending. The Fed supported the biggest banks to the tune of hundreds of billions of dollars. They spent it, shockingly, on themselves, while small businesses trying to get PPP loans couldn't sometimes get their phone calls returned. We ought to try something different. We need a banking system that works for everyone. We can't allow the biggest banks to funnel their extra cash into stock buybacks that juice their profits instead of investing in the real economy. We can't let big banks merge into bigger and bigger mega banks, making it harder for small banks to compete and leaving rural and black and brown communities behind. We need to strengthen the Community Reinvestment Act so that banks serve the communities still scarred by the legacy of black codes and Jim Crow and redlining. And we can't allow a repeat performance of the years during the last recession. Wall Street destroyed our economy, cost families their jobs and their homes and their savings, then came roaring back. Families limped along behind them. For the vast majority of Americans who get their money from a paycheck and not a brokerage account, the economy never looked all that great in the years that followed. Stable prices, moderate long-term interest rates aren't enough if every decade a financial crisis hits and strips away what people have worked so hard for. Low unemployment isn't enough if the jobs pay rock-bottom wages and workers have no power. GDP growth isn't enough if it only benefits those at the top and not the workers who made it possible. We need to create a different system, one that's stable for the long run, one where workers, not Wall Street, reap the benefits of a strong economy. Mr. Chair Powell, you're charged with ensuring both financial stability and with overseeing the biggest banks. Both those jobs are equally important. Each affects workers' jobs and paychecks in communities, and as public servants, our responsibility, yours, mine, Ranking Member Toomey, our responsibility is to the people who make this country work. It's up to us to grow an economy that delivers for them, not just those at the top. Ranking Member Toomey.
Thank you, Mr. Chairman. Welcome back, Chairman Powell. The economy certainly has come roaring back from COVID. GDP is above its pre-pandemic levels now, and the Fed forecasts GDP will grow by an amazing 7% this year. The unemployment rate is already at 5.9%, which the Fed expects to fall to 4.5% by the end of the year. And to put that in context, the average unemployment rate for the last 20 years before the pandemic was 6%. So with these conditions, the Fed's rationale for continuing negative real interest rates and a $1.4 trillion in annual bond purchases is puzzling. The Fed's policy is especially troubling because the warning siren for problematic inflation is getting louder. Inflation is here, and it's more severe than most, including the Fed itself, expected. And it is more than offsetting the wage gains, so leaving workers worse off despite their nominal wage increases. For the third month in a row, the Consumer Price Index was higher than expectations. Core CPI, which excludes volatile categories like food and energy, was up 4.5% in June, the highest reading in almost 30 years. And to be clear, this is beyond the so-called base effects. The two-year change in core CPI was at a 25-year high. And with housing prices absolutely soaring in many places to completely unaffordable levels, I have to ask, why on earth is the Fed still buying $40 billion in mortgage-backed bonds each month? Now, the Fed assures us that this inflation is transitory, but its inflation projections over the last year have not inspired confidence. Last June, the Fed projected that PCE, one standard measure of inflation, would be 1.6% for the 12 months ending 2021. Then in December, the Fed raised that figure up to 1.8%. And now the Fed's most recent PCE forecast for 2021 year-end is 3.4%, more than double what the Fed thought inflation would be a year ago. But in coming months, the Fed is almost certain to revise that projection up yet again, because so far this year, PCE has already risen by 6.1% on an annualized basis. So for the rest of the year, inflation would need to be nearly zero for the Fed's latest projection to be proven correct. I'm very concerned that the Fed's current paradigm almost guarantees that it will be behind the curve if inflation does become problematic and persistent for several reasons. First, as I've pointed out, the Fed has consistently and systematically underestimated inflation over the last year. Second, the Fed has announced that it'll allow inflation to run above its 2% target level. Well, it's already well above 2%. And third, the Fed insists that the inflation we're experiencing now is transitory, despite the fact that recent unprecedented monetary accommodation has certainly driven the inflation that we're witnessing. And since the Fed has proven unable to forecast the level of inflation, why should we be confident that the Fed can forecast the duration of inflation? And after all, you can only know that something is in fact transitory after it's ended. What if it doesn't end? If it's wrong, by the time the Fed knows and acknowledges that it's gotten it wrong, we could have a big problem on our hands. And past experience has shown it's very difficult to get the inflation genie back in the bottle once it's out. The Fed may have to respond by raising interest rates much more aggressively to rein in significant inflation, and that could have severe adverse economic consequences. So the Fed's current monetary approach seems based on the premise that it needs to prioritize maximum employment over price stability, despite the fact that employment policies enacted by Congress are clearly impeding our ability to get back to maximum employment. But I would argue it's not the Fed's job to attempt to offset flawed congressional policies at the expense of its price stability mandate. And when the Fed subordinates its price stability mandate to try to maximize employment, the Fed runs the risk of failing on both fronts because you need stable prices in order to achieve a strong economy and maximize employment. This is not a partisan argument. Prominent Democratic economists, including President Clinton's Treasury Secretary Larry Summers, President Obama's CEA Chairman Jason Furman, and many others have expressed their concern about the risk of rising and persistent inflation. Lastly, I just want to acknowledge the unique and crucial role played by the Fed in our economy and some of the responsibilities that attend to that. The ability to direct interest rates and control the money supply is, of course, an extraordinary power. And Congress has given the Fed a great deal of operational independence in order to isolate it from political interference. But Congress also gave the Fed a narrowly defined mission. I'm troubled by the Fed, especially some of the regional banks, misusing this independence to wade into politically charged areas like global warming and racial justice. I'd suggest that instead of opining on issues that are clearly beyond the Fed's mission and expertise, it should focus on an issue that clearly is its mandate, controlling inflation. If it doesn't, the Fed will find that its credibility and independence may also have turned out to be transitory. Thank you, Mr. Chairman.
Thank you, Senator Toomey. We have an 11 o'clock vote. I informed the ranking member and the chair we will work straight through and not break during that 11 o'clock vote. So we'll just figure that out. I'll introduce today's witness. Today we'll hear from Federal Reserve Chair Jerome Powell on the Fed's monetary policy, the state of the U.S. economy. Under law, he comes in front of us twice a year at minimum. The Federal Reserve plays a key role in making sure our economy and banking system work for all Americans. Chair Powell, thanks for your years of government service and for your testimony today. You're recognized.
Thank you. Chair Brown, Ranking Member Toomey, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. At the Fed, we're strongly committed to achieving the monetary policy goals that Congress has given us, maximum employment and price stability. We pursue these goals based solely on data and objective analysis, and we're committed to doing so in a clear and transparent manner. Today, I'll review the current economic situation before turning to monetary policy. Over the first half of 2021, ongoing vaccinations have led to a reopening of the economy and strong economic growth supported by accommodative monetary and fiscal policy. Real GDP this year appears to be on track to post its fastest rate of increase in decades. Household spending is rising at an especially rapid pace, boosted by strong fiscal support, accommodative financial conditions, and the reopening of the economy. Housing demand remains very strong, and overall business investment is increasing at a solid pace. As described in the Monetary Policy Report, supply constraints have been restraining activity in some industries, most notably in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production so far this year. Conditions in the labor market have continued to improve, but there is still a long way to go. Labor demand appears to be very strong. Job openings are at a record high, hiring is robust, and many workers are leaving their current jobs to search for better ones. Indeed, employers added 1.7 million workers from April through June. However, the unemployment rate remains elevated in June at 5.9%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Job gains should be strong in coming months as public health conditions continue to improve and as some of the other pandemic-related factors currently weighing them down diminish. As discussed in the Monetary Policy Report, the pandemic-induced declines in employment last year were the largest for workers with lower wages and for African Americans and Hispanics. Despite substantial improvements for all racial and ethnic groups, the hardest hit groups still have the most ground left to regain. Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price declines from last spring drop out of the 12-month calculation. In addition, strong demand in sectors where production bottlenecks or other supply constraints have limited production has led to especially rapid price increases for some goods and services, which should partially reverse as the effects of the bottlenecks unwind. Prices for services that were hard hit by the pandemic have also jumped in recent months as demand for these services has surged with the reopening of the economy. To avoid sustained periods of unusually low or high inflation, the FOMC monetary policy framework seeks longer-term inflation expectations that are well anchored at 2%, the committee's longer-run inflation objective. Measures of longer-term inflation expectations have moved up from their pandemic lows and are in a range that is broadly consistent with the FOMC's longer-run inflation goal. 2 boxes in the July Monetary Policy Report discuss recent developments in inflation and inflation expectations. Sustainably achieving maximum employment and price stability depends on a stable financial system, and we continue to monitor vulnerabilities here. While asset valuations have generally risen with improving fundamentals as well as increased investor risk appetite, household balance sheets are on average quite strong, business leverage has been declining from high levels, and the institutions at the core of the financial system remain resilient. Turning now to monetary policy, at our June meeting, the FOMC kept the federal funds rate near zero and maintained the pace of our asset purchases. These measures, along with our strong guidance on interest rates and our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. We continue to expect that it will be appropriate to maintain the current target range for the Fed funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As the committee reiterated in our June policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. As always, in assessing the appropriate stance of monetary policy, we will continue to monitor the implications of incoming information for the economic outlook and would be prepared to adjust the stance of monetary policy as appropriate if we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal. In addition, we're continuing to increase our holdings of Treasury securities and agency MBS securities, at least at their current pace, until substantial further progress has been made toward our maximum employment and price stability goals. These purchases have materially eased financial conditions and are providing substantial support to the economy. At our June meeting, the committee discussed the economy's progress toward our goals since we adopted our asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. We will continue these discussions at coming meetings. As we've said, we will provide advance notice before announcing any decision to make changes to our purchases. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. The resumption of our Fed Listens initiative will further strengthen our ongoing efforts to learn from a broad range of groups about how they are recovering from the economic hardships brought on by the pandemic. We at the Fed will do everything we can to support the recovery and foster progress toward our goals of maximum employment and stable prices. Thank you. I will look forward to our discussion.
Thank you, Chair Powell, for your testimony. Our economy looks a whole lot better today than it did last year. We still have a long way to go, yet many of my Republican colleagues have been stoking inflation fears, demanding that we pump the brakes on our economic recovery, complaining that we're just investing too much money in the American people. If my colleagues are suddenly concerned about the costs that have been rising for workers and families for decades, they can join Democrats in the fight to raise wages, to lower the cost of health care, to make housing more affordable, to pass the American Jobs Plan. Of course, most of them won't say aloud what all this inflation alarmism is really all about. It's simply they don't want workers to have more power. In reality, the biggest risk to our economy, Mr. Chairman, is not doing enough to empower workers and not doing enough to curb Wall Street greed and excess. Chair Powell, my question is, you've supported Vice Chair Quarles as the Vice Chair of Supervision, his efforts to weaken capital requirements of the largest banks through revisions to the stress capital buffer, and you oversaw weakened CCAR stress tests, which ultimately decide how leveraged the biggest banks are. Governor Brainerd has pushed back against your efforts to weaken financial regulations. President Rosengren of the Boston Fed made the case that strong financial regulation enables the Fed to be more aggressive in its full employment mandate. President Mester of the Cleveland Fed, President Kashkari of the Minneapolis Fed are outspoken on the need for the board to keep its eye on financial stability. Weakening financial safeguards doesn't help working families. It just increases the risk of a financial crisis, wiping out everything they've worked so hard for. We're finally making progress, as I said earlier, and workers are getting a better seat at the table. We can make the economy safer and fairer with higher capital requirements of the biggest banks. My question, Mr. Chair, is why have you been against stronger capital requirements and using the countercyclical capital buffer in curbing runaway executive bonuses and stock buybacks?
So I guess I would say with the stress tests, the severity of the stress tests has very much been maintained. The effect of the stress capital buffer overall was to raise capital requirements for the largest firms, and they did manage to get through the recent pandemic and the acute phase of it and the recovery, and did their jobs during the so I think that by and large our financial institutions are well capitalized. We limited their distributions during the pandemic, and their capital levels actually rose quite materially during the course of the pandemic. So the financial system is strong and the banks are strong. I have felt, and I've said on a number of occasions, that the level of loss-absorbing capital in the system is about right. I think the experience of the pandemic bears that out. I would be prepared to deploy the countercyclical capital buffer if I thought that the conditions we laid out were triggered, but I haven't so far felt that way.
Every time the Fed is, thank you for that answer, every time the Fed's taken action to lower capital standards, it claims that doing so would increase lending in the economy and would otherwise promote economic growth. That hasn't been what's happened. Instead, buybacks, dividends, executive compensation have continued to go up even during the pandemic. We empower workers by maintaining tight labor markets and strong financial regulations. I believe strong financial regulation enables the Fed to be more aggressive in helping workers, and that should be your mission. It's time, Mr. Chair, respectfully, you change the way you think about regulating the biggest banks. One other question, Mr. Chair. In addition to adopting pro-worker financial stability policies, the Fed can further help communities of color by leading the push for a strong update to the Community Reinvestment Act. We've seen some good developments there with a different controller of the currency. Last year, the Fed unanimously released a framework for modernizing CRA that was well received by representatives of the civil rights community and by banks. My question, Mr. Chair, is the Federal Reserve still committed to full, not piecemeal, full CRA modernization with an interagency approach, and what is the timing?
We're very much committed to that outcome, and I actually feel good about where we are on this. We're resuming our interagency discussions on it, and I'm optimistic that we'll come out with something that has broad support among the community of intended beneficiaries, and by the way, also among the financial institutions, and that it will be a good, solid updating after many years into the more technologically enabled era that will help the intended beneficiaries quite a bit.
And the timing, Mr. Chair?
Working on it now. I think you'll see we're reacting to analyzing and reacting to a very large quantity of comments and discussing that particularly with the OCC, but also the FDIC. It's not clear what their role will be at this time, but we hope they'll join in. I think we'll be making visible progress in coming months. I can't give you a finish date yet, but I think we're moving now.
Okay, thank you. We will be watching. Senator Toomey.
Thank you, Mr. Chairman. Chairman Powell, in your testimony, you said that substantial further progress is still a ways off for the economic recovery, and I think you cite that as a justification for the extremely accommodative policy that you have. I don't think you're referring to the need for substantial further progress in GDP growth. I think it's employment that you're thinking of. The unemployment rate has declined dramatically, but it hasn't reached the pre-pandemic lows. And I think you've also made references to the workforce participation rate. I guess my question is, isn't it entirely possible that for a variety of factors, not the least of which is legislation that we've passed, the labor force participation rate may not get back to the record highs that we recently saw, and we've made it more difficult for the unemployment rate to get back to the record lows that we were at before? And do you take that into account when you determine how much progress we've made towards full employment?
So what was happening toward the end of the very longest expansion, was that people were staying in the labor force later into their careers, and so labor force participation consistently remained above all estimates of where it was going to be. Then what happened in the pandemic was a lot of those people retired. So there have been really significant amounts of retirement. So the truth is, we don't know where that's going to settle out, and it'll take a period of years for us to really understand what the new trend is. I don't see that as a problem for the standard we've set forth for tapering asset purchases, which is substantial further progress. We're not going to need to know the answers to those questions to make a decision that we've made substantial further progress. It will be more of a consideration for raising rates where we've set a higher bar.
Okay, I just hope there's a focus on the distinct possibility that we're just not going to get to those levels anytime soon. Let me turn to housing prices a bit. The Case-Shiller Home Price Index showed housing prices across the U.S. as a whole increased in May by more than 15% from the previous year, and that wasn't a base effect. There was no big decline in May of last year. 15% clearly is making housing less affordable, more out of reach for more people. So a number of voices within the Fed seem to be increasingly concerned about this. The St. Louis Fed President James Bullard said just this week that he is, quote, a little bit concerned that we're feeding into an incipient housing bubble, end quote. Dallas Fed President Robert Kaplan said that the Fed should begin tapering to begin offsetting, quote, some of these excesses and imbalances, end quote. The Boston Fed President Eric Rosengren raised alarms that the Fed's mortgage-backed security purchases may be contributing to the current boom in real estate prices, citing the potential financial stability implications. I guess, I've been clear for a long time. I've been very skeptical about the ongoing mortgage-backed purchases. Are you at all concerned about the unintended consequences that are associated with $40 billion worth of mortgage-backed security purchases that continue month after month?
So housing prices are going up, as you mentioned, around 15%. This is a very high rate of increase. A number of factors are contributing. Monetary policy is certainly one of those factors. There are also other factors. People have very strong balance sheets, so they're able to make down payments. There are also supply factors that are constraining the supply, at least temporarily. So, my best thinking is that the difference between Treasury purchases and MBS purchases for this purpose is not a large one. Probably MBS purchases are somewhat more supportive of housing. That's not their intent, but that may be the effect. Really, the larger point is that monetary policy is supporting this, and that is something, that's a discussion we're going to be having on an ongoing basis. We talked about some of these things at our last meeting, and we'll talk about it at the next meeting in a couple of weeks.
I think that's important. Let me close with a question on a central bank digital currency. During your testimony yesterday, I sensed what I wasn't sure but thought might be a change in your tone about the virtues of a central bank digital currency being issued by the Fed. One of the things you said yesterday is that one of the stronger arguments in favor of a CBDC is that, quote, you wouldn't need stable coins, you wouldn't need cryptocurrencies if you had a digital U.S. currency. Of course, isn't the reverse also true? If you have stable coins, cryptocurrencies in use, then maybe there's no need for a central bank digital currency. I guess my 2 points. One is it's my view that the development of a central bank digital currency by the Fed would require congressional authorization. I'm wondering if you share that view. And secondly, it is still not clear to me what problem a central bank digital currency would solve, and I wonder if you think there are problems that only a central bank digital currency can solve.
So first, I'm legitimately undecided on whether the benefits outweigh the costs or vice versa or on a CBDC. Yesterday, I was answering a direct question about a particular argument. I said, in favor, that would be one of the stronger arguments. Okay. I would agree that the more direct route would be to appropriately regulate stablecoins, which we don't do right now, and that's going to be a very important thing that we do. So in terms of congressional authorization, there are different views on that. I've said publicly, and I think this is right, that we would want very broad support in society and in Congress, and ideally that would take the form of authorizing legislation as opposed to a very careful reading of ambiguous law to support this. It's a very, very important initiative, and I do think we should ideally get authorization. In terms of what the problem is to solve, I think that is exactly the right question, and I think our obligation is to explore both the technology and the policy issues over the next couple of years. That's what we're going to do so that we're in a position to make an informed recommendation. But my mind is open on this, and I honestly don't have a preconceived answer to these questions.
Thank you, Mr. Chairman.
Senator Menendez of New Jersey is recognized.
Chairman Powell, as the Federal Reserve seeks to fulfill its mandate of maximum employment, I want to discuss with you the tremendous impact that immigration has on the labor force. Isn't it true that over the past 10 years, the immigrant labor force participation rate has been consistently higher than that of native-born workers?
I believe that's right.
Yeah, and let me help you verify that. The St. Louis Fed noted in their study that as of June 2021, the foreign-born labor force participation rate is 3% higher than the native-born rate, and that gap hasn't ever been lower than nearly 2% for the past 10 years. And an important but often overlooked characteristic of these immigrants is their youth. According to the Bureau of Labor Statistics, 71.8% of foreign-born workers are between 25 and 54 years of age, compared to 62.2% of the native labor force. So as the American labor force ages, will immigrants, and therefore immigration policy, play an increasingly important role in maintaining a healthy U.S. labor force, therefore a healthy economy?
So, Senator, I'm going to stay away from making any recommendations on immigration policy. It's not in our wheelhouse. I will say that labor force growth is one of the two things that can drive the top line, the other being productivity growth. And, in recent years, immigration has been accounted for a significant part of growth in the workforce.
Well, I appreciate that. I'm not asking you about immigration policy. What I am saying is that one of the newest studies shows that nearly 1 in 4 Americans is projected to be 65 years of age or older by 2060. So while America gets older, the overall population is growing at a slower rate than it has in almost a century, leaving unfilled job openings in a future American economy. And I think we should be looking at our immigration policy, whatever that might ultimately be. I have my own idea, the U.S. Citizenship Act, as a source of dealing with the labor market. Now, let me continue on the question of the labor market. One part of the Fed's dual mandate is to maximize employment and understanding what factors inhibited people's ability to work as a key to helping achieve that goal. On page 7 of your monetary policy report, and I'll quote directly from it, the effect of the pandemic on employment was largest for workers with lower wages, for workers with lower educational attainment, and for African Americans and Hispanics. And these hard-hit groups still have the most ground left to regain. And the pandemic seems to have taken a particularly large toll on the labor force participation of mothers, especially Hispanic mothers. That's very much true. So have disruptions in childcare due to the pandemic had a negative effect on employment?
Yes, they have, and also schools being closed. Caretakers generally are having a hard time getting back into the labor force for that reason.
The Federal Reserve's data shows that the pandemic's effect on childcare caused 9% of all parents to be unable to work late last year, and an additional 14% of parents had to decrease their hours, and this effect was especially pronounced among Black, Hispanic, and low-income households. So is the effect on childcare and employment isolated only to the COVID pandemic?
Sorry.
Is the effect of the availability of childcare that is affordable on employment isolated only to the COVID-19 pandemic?
I'm going to guess, really, that the answer to that would be no.
Yeah, and it is no. Studies have shown that working families pay for childcare ending up 35% of their income on average, 5 times more than what the Department of Health considers affordable. So it seems to me that increasing the availability of high-quality, affordable childcare, like what President Biden proposes in the American Families Plan, has a positive effect on employment, enables businesses to more easily find qualified workers, and ultimately helps address supply bottlenecks. The same Fed study I just cited notes that reducing or offsetting the cost of childcare has a particularly strong employment effect on Black, Hispanic, and low-income families. The pandemic showed all of the inequalities in our nation, highlighted in a way so dramatically, and particularly communities of color. Now the employment challenges, we all talk about wanting to get people to work, the employment challenges that people have in being able to work, and they, as I have shown in the Fed's, St. Louis Fed statistics, more gainfully employed than native-born. It seems to me we should be working on making the pathway easier so that businesses can have qualified workers. Thank you, Mr. Chairman.
Senator Rounds of South Dakota is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, once again, it's good to see you, sir, and I have most certainly appreciated the time that you spent trying to not only educate us, but also to work with us. I understand that clearly you've made it your mission to adhere to the guidance for the Fed in which you work to maintaining 2% inflation over a period of time, as well as full unemployment or full employment. And when we talk about it, it's always a combination of which one you're more focused on and how you maintain that, while at the same time responding appropriately in a non-political way to the actions of Congress and the administration. I'm just curious, with regard to today's position, we're coming out of a pandemic. We've put a lot of fuel into the economy with direct payments and so forth, and people are trying to get back to work right now. And yet we've got inflation, which right now in this current state seems to be above a 2% rate. Can you talk a little bit about the measurement time period that you believe is appropriate for shooting for a 2% goal? And if there is a concern that you would express or that you follow up with when we talk about overinflating or perhaps putting fuel in, what concerns you would have and how you would respond to congressional activity?
So the inflation that we have today, what we said is that if inflation runs below 2% for an extended period, we want inflation to run moderately above 2% for some time. This is not moderately above 2% by any stretch. This is well above 2%, and we understand that. And it's also not tied to, the things that inflation is usually tied to, which is a tight labor market, a tight economy, that kind of thing. This is a shock going through the system associated with reopening of the economy, and it's driven inflation well above 2%. And, of course, we're not comfortable with that. In terms of the test that we articulated, we said we wanted inflation to average 2% over time. We didn't tie ourselves to a formula. What we really want is inflation expectations to be anchored at 2%. Because if they're not, there's not much reason to think that inflation will average 2%. So that's really how we're thinking about it. What's the challenge we're confronting is how to react to this inflation, which is larger than we had expected or than anybody had expected. And to the extent it is temporary, then it wouldn't be appropriate to react to it. But to the extent it gets longer and longer, we'll have to continue to reevaluate the risks that it would affect inflation expectations and will be of a longer duration, and that's what we're monitoring.
You've been very careful, and I've appreciated the fact that you have done your best to be apolitical in this regard, and yet at the same time we're going to have a debate about whether or not we need to add additional fuel to the economy in terms of additional payments to individuals. And as we make that discussion, recognizing that you're going to do your best to be apolitical and simply to respond based upon your goals of the long-term goal of 2% inflation and full employment, how do you see this right now with inflation right now being the focal point, and yet the possibilities of more dollars being put into this economy in this recovery stage? What concern would you express, if any? And I know that your job is not to give us advice, but rather to respond to. What are the tools available for you to try to maintain that long-term goal of 2% during a time in which Congress may very well be adding additional fuel to the fire, so to speak, for inflation?
So the way it works is we watch what Congress is talking about, and then ultimately, and there reaches a point at which our staff will say that looks like it's got a good chance of happening, and then we'll put something into the staff will put something into the forecast, and all of us will make our own judgment about whether that was the right thing to do, whether it's too big or too small, and we never then take that into the public sphere and say, please don't do that for this reason or that reason. It's really not up to us to play a role, as you know.
But the tool that you would use would be within monetary policy of the price of money.
Always, the tools we have, or in monetary policy, is to raise interest rates, to tighten financial conditions more broadly, to slow demand down, and that's how you get control of inflation, and that's what you do. At a time like this, though, policy is so accommodative. It'll still be accommodative after we slow asset purchases, ultimately stop them, and then raise interest rates. It'll be accommodative for quite a while. But that's what we do, and that's what we will do when and as we need to. In the meantime, we're trying to understand this particular inflation is just unique in history. We don't have another example of the last time we reopened a $20 trillion economy with lots of fiscal and monetary support. We don't. So we're just trying to be. We're humble about what we understand, but we're trying to both understand the base case and also the risks.
Mr. Chairman, thank you very much for your response. And Mr. Chairman, thank you.
Senator Round. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. And Chairman Powell, it's great to see you. Thank you for your good work. One of the issues that you and I spent a lot of time talking about over the last year plus has been access to capital issues. And as we know, COVID disproportionately hit communities of color. We lost 440,000 black-owned businesses last year. And as we've discussed in the past, I've been a big advocate with many on this committee on both sides of the aisle to promote investment into minority depository institutions, into community development financial institutions, and actually working with former Secretary Mnuchin, we got $12 billion into the relief package back in December. Some of that will go into, as you know, Tier 1 capital into the CDFIs, which could actually increase their lending capacity by about 50%. But getting that access to capital to low and moderate income communities is really, really important. Is there more that the Fed can do? Let me give you a two-part question. The Fed can do to support CDFIs, and is there anything similar to programs like the Fed's Paycheck PPP program, liquidity facility, which could also potentially be used? I know, again, we've discussed some of these things, but I'd like to see if what your current thinking has been on this issue.
So we do see, and we saw particularly during the pandemic, the good that CDFIs and also minority depository institutions can do and we're doing. And we try to provide whatever resources we can, and a lot of it is just engagement and things like that, and also including the CDFIs in the PPP liquidity fund and doing everything we could to incorporate them in a way that was useful to them. So all of those things are good. I think if we could think of more things to do within our mandate, given our authorities, we would do them, because we do see the good that they do in reaching communities that are not necessarily reached by other banks.
And I do hope, beyond CRA, that we can, look at. I've got a lot of community banks as well that want to try to get into this market, and got some ideas I'd like to come back to you and the Fed on, because I think sometimes there's a feeling that there's not enough regulatory discretion if they want to kind of lean into lending into low and moderate income communities. I wanted to raise one other issue. I think we all know housing prices are up dramatically. Matter of fact, the Federal Housing Finance Agency's House Price Index showed that house prices were up 13.9% over the 12 months ending in March 2021. I know a lot of discussion around inflation here. Obviously, if the housing market is overheated, that poses a huge issue. Is there, how overheated do you think the housing market is at this point? And what kind of tools do you have that could help deal with that problem?
Price increases are very strong in housing, and it's right across the country, and we see that, we hear that everywhere. And there, as I mentioned, there are a number of factors at work there, both demand and supply. There's a lot of demand because household balance sheets are just in the aggregate, in very strong shape. Monetary policy is clearly supportive of people who want to get mortgages now, although most of the people getting the mortgages have very high credit ratings. It's very different than it was before the global financial crisis. There are also, both their supply constraints and this predates the pandemic, and this problem is still going to be there when every other problem is solved, which is difficulty in getting zoning, in getting trained workers. The raw material shortages and high prices and bottlenecks will probably abate over time, but it's not. I've heard from many of you that this was a problem before the pandemic, and I think that's probably going to remain the case.
Well, I agree. I think the supply issue is something we have to address, and Chairman Brown has been working on this. I've been working on some ideas. I also think one of the things we've got to grapple with, if we go back again to the kind of wealth gap issues, particularly racial wealth gap, 10-to-1 black versus white families, a lot that goes to home ownership. But I think it's also a challenge not only for black families, but for first-generation home buyers anywhere. I've been working on an idea that somebody else brought to me that would say, can we in effect, using Ginnie Mae with a slight interest rate subsidy, almost provide for the same payment you would have on a 30-year mortgage, a 20-year mortgage product. We've called it the Lift Up program, and I think my time's expired, but I'd love to share more of that with you, and as I'll share with my colleagues. Thank you, Mr. Chairman.
Thanks, Senator Warner. Senator Kennedy from Louisiana is recognized for 5 minutes.
Mr. Chairman, I want to begin by thanking you once again and your colleagues, some of whom are sitting behind you. We all remember spring of 2020, when the world economy almost melted down. It didn't in substantial part because of the actions that you and your colleagues took. You kept this thing in the middle of the road. Now, some days you had to do it with spit and happy thoughts, but you kept it in the middle of the road. I remember particularly your currency swap lines. You didn't read a lot about it, but I can understand when the world's melting down if other countries seek out treasuries, but when they don't like treasuries, they want hard, cold American dollars. That's scary. So I want to thank you. This is my question. We have spent, not just during the Biden administration, but during President Trump's administration, we have spent an enormous amount of money. I mean, it's breathtaking. And now some agree with it, some disagree with it, but some say you shouldn't have done it. Some say we had to do it. It's probably a little bit of both. A lot of it wasn't paid for. And I look around, and President Biden is asking us in the next, 6 months to spend, another $5.5 trillion? And there's a lot of talk about pay-fors, but it won't all be paid for. We know that. At what point do these deficits matter? Are we living in a different world? I mean, I know you'll probably say, well, deficits always matter, but at what point does the marginal benefit of the extra deficit spending become less than the marginal cost?
I don't think there's a precise point that I can identify. I will say that we're not on a sustainable path. We actually haven't been for a long time. That just meaning that the debt is growing substantially faster than the economy, and in the long run, that is not sustainable. We're going to need to, that the laws of gravity have not been repealed. We will need to get back on a sustainable path at some point. I think the time to do that is when the economy is strong, unemployment is low, taxes are rolling in. That's the time to do it, and to do it, with a longer-term plan that matches up our spending needs and our revenues. That's what we're going to need to do. We will eventually have to do that.
When do you think that will be?
I wish I knew. I mean, I would say, the dollar is the world's reserve currency. People are buying our paper around the world. I don't think there's, any issue of being able to fund our deficits in the near term and the medium term. There's no evidence that there is, but, we shouldn't wait until the urgent need arises.
Yeah, it's too late then. Well, everybody seems to be a Keynesian now, and that's fair. Dr. Keynes was brilliant, but some people forget about that chapter in one of his books where he said, okay, you deficit spend and you borrow to stimulate your economy, but when it's better, you pay it back. He said that very clearly. You pay it back. The other thing that none of us wants inflation. But it's not just inflation, as you know much better than I do. It's inflation expectations. And I worry that if we spend this extra $6 trillion or $5.5 trillion that President Biden wants to spend, that the private sector is going to say, we're going to have more inflation. I don't care what they say at the Fed. We're going to have more inflation, and we're going to start raising prices. I mean, you don't have to be Einstein's cousin to figure that out. Don't you think that's something we have to consider?
Well, I would agree with you that inflation expectations are really central to what we think are central to what creates actual inflation. We see them now being, they've moved up. They moved down at the beginning of the pandemic. They've moved back up roughly to where they've been in recent years, so they're not at a troubling level.
Okay.
But it's something we'll be carefully watching.
All right. Last point, I'm not expecting a response. Resist the pressure. You're going to be asked by a lot of people to get involved in social policy, in cultural matters, and in what some will call economic policy that really has nothing to do with the Fed's mission. And it's not just happening here, it's happening all over the world. Don't let us become Turkey, where the whole central banking system is politicized. Please resist it. Thank you, Mr. Chairman.
Thank you, Senator Kennedy. Senator Smith from Minnesota is recognized for 5 minutes.
Thank you, Chair Brown and Ranking Member Toomey, and thanks so much, Chair Powell, for being with us. I appreciated the chance to have a longer conversation with you earlier this week. I want to try to touch on two issues that are important to me. The first is just following up briefly on Senator Brown's questions around the Community Reinvestment Act, and then I want to go to the systemic risk that climate change poses. So earlier this week, you and I had a chance to talk about this, and I see the Community Reinvestment Act as the main rules that govern how banks provide services in low and moderate income communities and communities of color, which have experienced a systemic and severe lack of access to capital and lending and financial services due to discrimination. I'm glad to hear you think that you'll be seeing some updates in the coming months, and I wonder if you could just tell us a little bit more about what the Fed has learned from all the comments that you've received from the CRA proposal that you released last year.
So quite voluminous comments, as you can imagine, from all corners. And I think we're learning a lot, and we're going to incorporate improvements. But broadly speaking, this proposal, this approach, has the support of the intended beneficiary community, and also, to a significant extent, the support of the banks, who want, they want CRA to be effective. They want it to be well measured. They're committed to having it being an effective program, so I believe. And so generally, we're in the middle of setting up to try to write something that reflects those, the appropriate comments, and then we'll publish that again. But it'll take some time, and we do hope to get all of the banking agencies on board for that. So as I mentioned, I'm optimistic that this is going to a pretty good place.
That's great. I'm glad to hear that. I think that a well-functioning and modernized CRA is just absolutely crucial to making sure that all sectors of our economy, for all people, are growing and working. And as Senator Brown says, that we fulfill that promise that we all do better when we all do better, which I think is at the heart of the CRA. So thank you. Let me just move to this question of the risks posed by climate change. Yesterday in your testimony before the House, you indicated that the Fed is in the beginning stages of working on a program that will engage with financial institutions on climate risk. And the last time you came before the committee, you said that you believed it was important longer term for firms to publicly disclose their climate-related risks. And since then, the SEC has received hundreds of comments. Vice Chair Quarles has highlighted the importance of climate risk disclosure, and I believe SEC Chair Gensler has signaled his intention to begin rulemaking around climate disclosure. So can you comment on how you see the role of the Fed on climate risk disclosure for financial institutions?
I guess I'd start by saying that really the foundations of all of this are that we need to get good data on the implications of climate change and how to think about that in terms of the risks that the financial institutions and other parts of the economy are running. And so that's a very basic exercise, and we don't have that yet. Once you have the data, then disclosure is going to be important because markets are going to work. Markets are going to be very, very important, and the world investor community will be very interested in this. So those two things, and those are, the Fed can help with research and data collection, things like that. The disclosure issues are really squarely in the province of the SEC, and I know they're working very hard on those. And around the world, there's a lot of progress and focus on these things, and I just think they're quite central to anything that we are ultimately able to accomplish here.
So I think it's fair to say that the European central banks have led the way here. What can we learn from the approach that they've taken?
I think one thing I would point to is the climate stress scenarios that have been developed by the Network for Greening the Financial System, and a number of the major European central banks are running climate stress scenarios, very distinct from stress tests. And what they're really trying to do is with financial institutions, look at what the effect over a long period of time on their business and on their business model could be from, reasonably plausible climate, outcomes for the evolving climate. And it's proving to be, I think, a very profitable exercise both for the financial institutions and for regulators. So that's one thing. Now, we haven't decided to do that yet. We're in the process of looking very carefully at that. My guess is that's a direction we'll go in that we're not ready to do yet.
Thank you. Mr. Chair, I realize I'm out of time. I want to just note that I think that some would say that climate risk is a political issue. I see it as a systemic financial risk, just like other systemic financial risks that big banks and small, medium-sized banks have to address. So I think that it's extremely important. I urge the Fed to continue to look at these impacts and to move with alacrity because I think, as you say, Chair Powell, I believe that the markets are looking for clarity about how to measure and how to assess these risks for the good of investors and for everybody. Thank you.
Thanks, Senator Smith. Senator Haggerty of Tennessee is recognized for 5 minutes.
Thank you, Chairman Brown and Ranking Member Toomey. I appreciate your holding this important hearing that has to do with our critical job of overseeing the Federal Reserve. And Chair Powell, I want to thank you for being here with us again. Today, I'd like to talk with you about inflation. Inflation is the insidious tax that the Biden administration is imposing on everyday working people here in America right now, and it's of great concern. Back in February, I discussed with you about how the U.S. economy at that point was forecast to see 6% growth this year. And at that point, I expressed serious concerns about the Democrats' nearly $2 trillion of additional partisan spending on an economy that was already recovering very rapidly, thanks to the effects of Operation Warp Speed, and also thanks to the policies that have been in place during the previous 4 years that have put our nation on a solid footing in terms of tax cuts, fair and reciprocal trade, and deregulation. The Federal Reserve's challenging and dual mandate is to realize price stability and maximum employment. But runaway Democrat spending and policies that they are imposing are making your job harder than it already is. The bill that Democrats rammed through in March spent roughly 10% of our GDP. And now they're looking to spend maybe another 20% of U.S. GDP on a purely partisan basis. They're throwing around trillions of dollars like it was simply monopoly money, when really what it's doing is taxing Americans' hard-earned paychecks. It's very irresponsible. It's creating inflation outcomes that many of us haven't seen in our adult lifetime, certainly not since Jimmy Carter was president. Echoing what Ranking Member Toomey has said, the concerns that he's raised about inflation, I worry too that things may spiral out of control if we don't show some restraint. At the same time, President Biden and the Democrats are imposing policies that work against maximum employment. They're giving away employment incentives. They're raising taxes on job creators, throwing away our energy independence, and freezing American investment. The Fed has more direct control over inflation and price stability than it does over employment. Businesses create jobs, and price stability allows American businesses and families to make business decisions and to plan their everyday finances. But now, Americans have a sense of scarcity, and I believe a sense of panic over inflation. The policies that are being imposed are causing families in my home state of Tennessee and all across America to make financial decisions with soaring inflation in mind. Price stability is not a 12% annualized inflation jump like the one we just saw from May to June. People in Tennessee are seeing their buying power eroded like never before, and they don't see this as transitory. And I'm sure people in Chairman Brown's home state of Ohio and Ranking Member Toomey's home state of Pennsylvania are feeling exactly the same way. As you know, inflation expectations can be self-fulfilling. Inflation and price instability at this level is bad for America. Chairman Powell, this environment suggests to me that the emergency posture that I understand the Fed adopted back during the depths of the pandemic seriously needs to be reconsidered right now. And I'm very worried that the Fed's continued level of asset purchases and balance sheet expansion is facilitating this runaway spending that the Democrats are imposing upon us and adding to the inflationary pressures that these trillions of additional dollars are going to continue to add to our economy and continue to add to the debt that our children are going to continue to bear. And it's amazing to me that not one Democrat in Congress is willing to speak out about this. So, Chairman Powell, why is the Fed maintaining its emergency monetary policy posture right now, and why do I understand that it may continue well into 2023?
So where we are is we're watching the evolution of the economy. We're noting that there's still an elevated level of unemployment. We note that inflation is well above target, and we've discussed that. And we've said that we would begin to reduce our asset purchases when we feel that the economy has achieved substantial further progress measured from last December. So we're in active consideration of that now. We had a full meeting last month to discuss that. We've got another meeting coming up in 2 weeks. So we'll be making that assessment. And as we assess the progress of the economy toward that goal, we will begin to reduce our asset purchases. We've set a separate test for raising interest rates, which is a higher test. And so that's how we're thinking about this today.
The policy positions that have been undertaken by this administration go far beyond the transitory nature that you described. And again, if I think about the expectations of the people in my home state, they're very, very concerned about inflation, so I'd like to pass that along. I'd also like to ask you just a very simple question. Does continued government stimulus spending at this point make your job in terms of sustaining price stability more difficult?
So we're not in the business of giving Congress advice on fiscal policy, and I just have to leave that to you. We take whatever you do and we put it into our considerations of policy, but we don't comment on it one way or the other.
Thank you, Mr. Chairman. Thank you, Chairman Brown.
Thanks, Senator Hagerty. Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So the chairman of the Federal Reserve has two basic jobs: monetary policy, which everybody likes to talk about, and regulatory oversight, which is often way down in the weeds but keeps our economy safe from another banking meltdown. You've been chair for 4 years now and have gone through the process of what you describe as, quote, tailoring the regulations put in place after the 2008 financial crisis. Now, there were a lot of changes, but I want to talk about a couple in particular. To prevent taxpayer bailouts, banks are required to have living wills. This means that banks must be able to show every single year how they could be shut down without wrecking the entire economy. In 2019, you changed the rules so that the 13 banks with $250 billion to $700 billion in assets could submit full living wills only once every 6 years instead of every year. So that test is now weaker. Chair Powell, has the Fed done anything over the past 4 years to make living will requirements stronger?
To make living will requirement, we've done a lot of things to strengthen regulation and capital, but I think
on living wills,
No, I
okay.
can explain what we.
So let's move to another regulation, the Volcker Rule, the rule that works sort of like Glass-Steagall Light to separate commercial banking from Wall Street risk-taking. In 2019, you exempted more short-term trading holdings from the rules, so banks could take on a little more risk. Now, that weakened the rule. Then in 2020, you eased up the rules to let banks invest more of their assets in high-risk private equity and hedge funds. So the Volcker Rule got weaker again. So let me ask, Mr. Chairman, during the past 4 years, has the Fed done anything to make the Volcker Rule stronger and limit risky trading for the largest banks?
I think by clarifying it, we made it more effective at what it's supposed to do, which is just what you said.
Well, I have to say, it's whether or not you did anything to make it stronger, not just whether or not you made it clearer. It's whether or not you made it stronger or harder for banks to engage in speculative trading. So I'm taking it that the answer here is no. I've highlighted two examples of weakening regulations, but there are a whole lot more. Reducing capital requirements, easing liquidity requirements, shrinking margin requirements, scaling back on supervision, weakening the stress test. It's a long list, and I realize that you think these are good changes, but I'm trying to look at this from a regulatory perspective. Is the chairman of the Federal Reserve making banking rules stronger or weaker? So tell me, Mr. Chairman, is there a big rule change that I missed? Can you name a change that strengthened the rules and made the actual rules tougher?
Well, let me say we did not weaken capital requirements for the largest banks, and I actively resisted any move in that direction. And in fact, the stress capital buffer, which we implemented quite recently after years of consideration, raises capital standards for the largest banks. By the way, stress tests, they're really bound by the stress tests. We maintained the very high stringency of the stress tests through this period.
So, but what I was asking about anything tougher, look, what I'm looking for is that the Fed's record over the past 4 years, I see one move after another to weaken regulation over Wall Street banks. And that worries me. There's no doubt that the banks are stronger today than they were when they crashed the economy in 2008, but that's the wrong standard. The question is whether or not they are strong enough to withstand the next crisis, and whether the Fed is tough enough to protect the American economy and the American taxpayer. In 2020, the giant banks that are the beneficiary of these weakened rules made it through the crisis. But the researchers from the Minneapolis Fed found that the banks would have faced up to $300 billion in losses if not for fiscal stimulus from the government. In other words, the current Fed rules were not strong enough for the banks to withstand the pandemic without, once again, calling on American taxpayers to back them up. And that's the heart of my concern. I understand that the next crisis may feel far away, but like the pandemic, it may come at us fast and from an unexpected direction. It is the job of the Federal Reserve, and specifically the job of the chair of the Federal Reserve, to use the regulatory tools that Congress has created in order to make sure that banks remain strong and that taxpayers will never be called on again for a bailout. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator Tillis from North Carolina is recognized for 5 minutes.
Thank you, Mr. Chair. Chairman, thank you for being here. I wanted to go back and maybe give you an opportunity to respond to one question. You were going to explain the work on living wills. Would you like to explain what the work you've done there?
I would just say that's was an incredibly labor-intensive and taxing issue that we went through cycle after cycle after cycle, and really the marginal gains from doing it every year diminished quite a lot. And so we concluded that for the largest banks, we wouldn't require a full resubmission except every other year. But they have to anything that's material, they must resubmit. I don't think in any way we've weakened our understanding of their resolvability or anything like that. I would also say we raised capital standards on the largest banks, full stop, in the stress capital buffer. They're higher now than they were. So I would say that.
With respect to the Volcker rule, you were talking about clarifications. I mean, is the Fed fully enforcing the Volcker rule based on congressional intent?
Absolutely. Look, I think it's important. It's more broadly, I would completely agree that our job is to maintain the strength of these large financial institutions so that we never have to worry about bailing them out again. And I'm strongly committed to that. We need them to be very, very strong so that they can perform the roles that they're supposed to perform, even in a severe crisis. And I think they by and large, did, admittedly with a lot of fiscal support and a lot of monetary support too. We can always do better, but we are committed. I am committed to that.
Thank you. I've got to beat the inflation drum for just a minute here. The FOMC members insist inflation is transitory, but it hasn't inspired a lot of confidence in me. There was a couple of statements by President Mary Daly. In February, she declared the pressures on inflation now are downward. In May, when inflation readings were at 3.9%, she said the higher inflation readings would mean 2.4 to 2.6%. In June, she was predicting that inflation could go above 3%, and despite months of relatively low ball projections, and in response to Tuesday's high inflation reading, she confidently declared, "We expect a pop in inflation like this." So I hope from our perspective, you could see that we're skeptical about some of the inflation projections. And I've spoken with a number of people in the financial services industry, and when I ask them the question about transitory, I'm getting more of a response now of transitory-ish. So can you give me a reason why you believe the Fed's position on it being transitory, that it will snap back, why that's still well-founded?
Sure. So let me start by saying that no one has any experience of what it is to reopen the economy after what we went through, and so all of us are going to have to be guided by data and our views are going to have to be seasoned
and
with
Chairman, let me interrupt you for a second. I'd also like for you to answer that question in the context of the flow of money that's been passed in the prior COVID relief packages. And we heard an announcement this week from the Speaker of the House and Senator Schumer that they have an agreement on another $3.5 trillion. I'm a part of a working group for infrastructure that could add about another $600 billion. So answer the question in the context of how that future, according to the leadership of Congress, outcome is going to occur. How does that all fit into the credibility of future inflation projections?
So when we look at inflation, we look in the basket of things and we say which of the 100+ things in the CPI basket are causing the high inflation reason. And it comes down to really a handful of things, all of which are tied to the reopening. It's used, rented, and new cars. It's airplane tickets. It's hotel rooms, and it's a handful of other things. And they account for essentially all of the overshoot. And we think that those things are clearly temporary. We don't know when they'll end, but they'll go away. So we don't know when they'll go away. We also don't know whether there are other things that will come forward and take their place. You know, what we don't see now is broad inflation pressures showing up in a lot of categories. The concern would be if we did start to see that. We don't see that now. We'll be watching carefully. And we won't have to wait, a tremendously long time, I don't think, to know whether our basic understanding of this is right. We will know because we'll see other more. If we see inflation spreading more broadly, that'll give us information.
I just want to get one more in. I appreciate that, and I listened to your responses from some of the other members. With the LIBOR transition, do you still view, I think you publicly stated, Ameribor as a reasonable choice for regional and community institutions. Do you still stand by that?
You know, we don't like to bless individual rates, but I would just say market participants have the freedom to choose the rates that they want to choose. We're not forcing them to use. This is for just use.
But I am
the thing
confirming.
They can't use is LIBOR.
In sub-public comments, you have said it's an appropriate rate for banks and funds through the American Financial Exchange. You still stand by that statement?
I saw that. I don't remember saying that, but it was in a letter, I think. So
okay,
I must have done it.
Thank you, Mr. Chairman. Appreciate your work.
Thank you.
Thank you, Senator Hill. Senator Tester of Montana is recognized for 5 minutes.
Yeah, thank you, Chairman Brown. I want to thank Chairman Powell for being here today. A lot of chairmans around here. But look, I have appreciated you and I've appreciated your work during your tenure. And especially as we look back over an incredibly difficult period of time where you were having to take a lot of issues that we hadn't seen in 80 years under consideration, getting attacked, trying to politicize the Fed. I just want to thank you. I appreciate it. I think your expertise and your knowledge has shown through. The cream has risen to the top, so to speak. So, thank you. Look, there's a lot of talk about infrastructure needs, and I think that you would probably agree that China is trying to take over our role in this world of being the economic superpower. And I'm one that believes that infrastructure and investments in infrastructure is critically important if we're going to maintain our position as a worldwide economic power, the worldwide economic power. My question for you is as you look at infrastructure investments and how that affects our economy, where would you put your focus?
I don't have any. I mean, I would just say that well-spent, well-invested infrastructure money does have the ability, and it's really up to you to make those decisions. But it's the kind of thing that can actually raise the growth rate, the potential growth rate of the country over time. But I guess I need to leave the details.
So I think that there's several proposals out there. There's proposals to invest in roads and bridges and broadband and grid, which some of us in this room are a part of, that I think is really, really important. I think there are other proposals that are also very important, but they're investing in a different kind of infrastructure like childcare and workforce housing and those kind of things. I don't mean to put you on the spot, but I do value your opinion. Where do you think those things fall? Are they equally as important, or do you think that the economy is fine without any investment in those kind of things like housing and child care and that kind of stuff?
I don't want to get into. I wouldn't get into the debate over whether those are infrastructure or not. But
right? No. I'm just from an economic standpoint.
From an economic standpoint, take child care. We used to have the highest female labor force participation rate among the advanced economies. Now we're close to the bottom of the pack. And one of the differences economic researchers point to, there's a lot of research on this, is just a different approach on child care. And it's really up to you to look at that and see whether that makes any sense in the U.S. context. We don't have an opinion on that, but that's a basic economic trend where we used to lead and we don't anymore.
Okay. So let me ask you this. I don't know. I know that many in the Fed have done some work on issues in Indian country, and one of the issues in Indian country is housing. They have a different situation because of their sovereignty and as of not having the kind of collateral that folks who own property have, that land on the reservation I'm talking about. Do you have any thoughts on that, on what we could be doing outside of the whole infrastructure conversation? Just what can we do to impact Indian country when it comes to housing? Because, man, it's woefully bad.
That's a hard question, and as you know, we have 4 or 5 reserve banks that are involved, particularly Minnesota, Minneapolis, in Indian country issues. We're not allowed to spend. We don't spend taxpayer money on things directly like that. But I think we would agree that there's a significant housing issue in Indian country, and I'm not sure I have the answer.
So if you have if you have any ideas that pop into your head about how we can, I don't know, incentivize is the right word, but how we can engage the private sector to do some housing so that they would be more inclined. And look, I get their point of view. It's not traditional. They don't have the kind of collateral that they would have with fee property. So it is an issue. Look, I appreciate what you're doing. I'm about out of time, but I just want to thank you for your work. I appreciate you being in front of the committee today, and good luck.
Thanks, Senator.
Thanks, Senator Tester. Senator Shelby from Alabama is recognized for 5 minutes.
Thank you. Chairman Powell, we've been talking about inflation, and it's not going to go away, I think, for a while, so we're going to continue to talk about it, and you'll be concerned with it. In June, U.S. inflation accelerated at its fastest pace in 13 years. Consumer prices increased by 5.4% from a year ago. Americans are now paying higher prices for many of the goods and services that they cannot do without. The buying power of the dollar has diminished over the past 40 years. I'll give you some examples. You know all this. According to the Bureau of Labor's Consumer Price Index, $1 today is 7 times less valuable than it was in 1970, 3.5 times less valuable than in 1980, half as valuable as 1990, and 1.5 times less valuable than 2000, which seems like yesterday. Recently, the price of commodities, as you know, has increased swiftly. The price of agricultural goods, commodities, has increased. Corn by 50% from a year ago. Wheat by 17%. Soybeans by 54%. The price of metals has risen. For example, copper, which is used everywhere, has increased 43%. Aluminum has increased by 47%. Energy prices, as you know, again, have grown. The price of crude oil has increased by 70%. Gas prices are up 45%. In the automotive industry, prices for used cars rose 45% in the past year, 10.5% in June alone. Airline tickets are up 25%. The cost of milk is up 7.5%. All of this on the rise. At this point, the Biden administration continues to claim that the increases in inflation are temporary. I, along with others, believe that this could be the sign of things to come. We hope not. For instance, economists surveyed by the Wall Street Journal this month forecasted higher inflation for the next couple of years. Throughout the 70s, as you will recall, high inflation crippled consumers with rapid and sudden price increases. Many of those conditions exist today, such as loose monetary policy and significant government spending. If we fail to take inflation seriously, Mr. Chairman, I'm concerned that our nation could be faced with the same challenges of years ago. Yet in the midst of the increase in consumer prices, which I've just related, the Biden administration is proposing trillions more in government spending. The Fed's ability to maintain price stability is threatened, I believe, by actual or inflation or the expectation of inflation. Chair Powell, my question is this. Taking all this into consideration, which you have data that we probably don't have, do you believe that this nation, our nation, is facing a real problem with inflation? And if not, why not? How do you justify it?
I think we're experiencing a big uptick in inflation, bigger than many expected, bigger than certainly than I expected, and we're trying to understand whether it's something that will pass through fairly quickly, or whether in fact we need to act. One way or the other, we're not going to be going into a period of high inflation for a long period of time because, of course, we have tools to address that, but we don't want to use them in a way that is unnecessary or that interrupts the rebound of the economy. We want people to get back to work, and there are a lot of people who are not back to work yet. So, but let me say, very well aware of the risks from inflation, watching very carefully, and you know, if we come to the view that, or if we see inflation expectations or the path of inflation moving up in a way that's troubling, then we will react appropriately.
Are you concerned about all the things that I just related, all the price increases, unprecedented in recent years, or are you just putting that aside?
No, I mean, we're you know, night and day. We're all thinking about that, and really asking ourselves whether we have the right frame of reference, the right framework for understanding this.
Lastly, do you agree with the economists that I referenced, that the Wall Street Journal poll, who forecast higher inflation rates for the next couple of years, notwithstanding?
So that was the headline writer really got a little carried away there because the actual forecast showed that the median for 2022 was 2.3% PCE inflation, and for 2023, 2.2% PCE inflation, which is not at all different from the forecasts of the people on the Federal Open Market Committee. So those are higher than for the last 30 years, but they're not that high. So that forecast was not really as problematic as the headline suggested.
Thank you, Mr.
Thank you,
Chairman.
Senator Shelby. Senator Cortez Masto is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, welcome back. Let me follow up on this. Are you confident that you have the tools that you need to address any type of inflation, whether it's transitory or for the future, that we are looking at right now?
Yes, I am.
Thank you. And can I ask, in considering inflation, how should we compare costs to last summer when prices were well below their current levels because of the pandemic?
I think it's actually, in the spirit of your question, it's better to compare prices to prices where they were in February. And if you look at inflation since then, that captures both the decrease and the increase. And you get much lower numbers if you do that. There are a lot of people doing that right now. So you get inflation in the mid-2s, which is still above our target, but that sort of 16-month inflation on an annualized basis is 2.5% kind of thing, not 5%.
Thank you. And then for purposes of the COVID relief packages, all of them, including the most recent one, the American Rescue Plan, is that the sole cause for what you see with respect to the minimum increase in inflation?
I think a lot of things go into it. You know, the main thing is that we have demand rebounding very, very strongly. That's partly monetary policy. It's partly the fiscal policy. And what we see on the supply side is a supply side that just can't keep up with this demand and all these bottlenecks. And by the way, it's happening everywhere in the world. So it's a combination of factors.
And so unlike the last recession that we lived through in 2010 to 2014, would you, I'm curious, would you, and this is my interpretation of it, is that when our economy opened up from that, it was a gradual opening up of our economy again. And this is more of a kind of a light switching on with the economy opening up quickly. And that's why we see some of the concerns with supply and demand on so many different areas. And that's why we see highly concentrated sectors where there's a demand like you've touched on tonight or today. Is that accurate?
It is accurate, and I would add that the response, both from fiscal and monetary policy in this episode, is just orders of magnitude different from what has happened in the past. So we're back to pre-COVID levels of economic output, and we're on a path to be above the prior trend, actually, within a year if forecasts prove out.
Thank you. You know, in Nevada, our employment rate has fallen sharply since the pandemic last spring. Unfortunately, we are still fourth in the nation for unemployment. But as I watch our economy open up again, and particularly when you and I have talked about this, as tourism and travel industry is starting to rebound again, which is fantastic. Last month, more than 130,000 people applied for 6,000 positions at a new resort in Las Vegas. Part 5 of the Federal Reserve Monetary Policy Report notes that, and I quote, payroll employment increased by 3.2 million jobs in the first half of 2021, driven by a 1.6 million job gain in the leisure and hospitality sector, where the largest employment losses occurred last year. The May 2021 Federal Reserve research paper, however, found that the extra jobless benefits that were provided during the pandemic, quote, and I quote this, likely had little or very small labor supply induced impact on the unemployment rate. Can you elaborate on that?
So I think that was Reserve Bank research, and I think it was referring to 2020. It's too soon to really say what the facts are going to be here. In fact, we'll be able to learn something because many states, as you know, have stopped the additional benefits, and we'll be able to look and see whether that had any effect on people going back to work. It's way too early to say. There's not enough data.
And thank you for saying that, because that was my next question. You will be studying that data to see the difference between those states that cut it off early versus those that kept it going, whether that truly was an impact or not.
Yes, everyone's looking to see whether there will be a meaningful difference between the two. And again, too early to say on that.
I appreciate that. Thank you. And then finally, we touched on housing. We are seeing this home prices are up more than 15% since last year. How much of the rise in home prices do you think are due to the Federal Reserve's purchase of mortgage-backed securities versus the supply issues?
So I think that our purchases of treasuries and MBS are what is holding down and also holding interest rates low. The overall picture of accommodative monetary policy is contributing to what's happening in the housing market. I think mortgage-backed securities are contributing probably a little more than Treasury securities, but ultimately it's roughly the same order of magnitude. So, sorry, was that your question?
Yeah, thank you. No, I appreciate that answers my question. Thank you very much.
Thank you.
Thanks, Senator Cortez Masto. Senator Daines of Montana is recognized for 5 minutes.
Thank you, Mr. Chairman. And Jerome Powell, good to have you here today. And thanks for keeping a steady hand here during these rather tumultuous times. I want to start by joining my colleagues in expressing my concern with the inflation we're seeing in the economy. This week, we received 2 inflation readings. They were the highest increases we've seen in over a decade and reflect what Montana families are already feeling, and that is prices for everyday necessities, they're going up. At the same time, Majority Leader Schumer, Senator Sanders, Senate Democrats are proposing another massive, partisan, $3.5 trillion tax and spend package. I truly believe this is reckless. It threatens short, medium, and long-term prosperity of our country, and I sincerely hope my colleagues on the other side will reverse course. With that, I'd like to turn to my questions. Chairman Powell, the unemployment rate has consistently fallen since the height of the pandemic. Now at 5.9%, down from a pandemic high of 14.8% back in April of 20. I'm truly grateful, as I know you are, to see this rate fall, more Americans getting back to work. However, we're kind of digging into this and have concerns about the labor force participation rate, which now sits at 61.6%. It's remained in a narrow band between about 61.4% and 61.7% since June of 20. The current labor force participation rate is 1.7 percentage points lower than it was pre-pandemic in February of 20. A significant percentage of those folks who've dropped out of the labor force are over the age of 55. And recent data shows that they're not re-entering the workforce. A lot of those folks, as they are already nearing retirement age, may never re-enter the workforce. And my question, Chairman Powell, is do you expect the labor force participation rate for those 55 and older to recover to pre-pandemic levels, and if so, why?
So you very accurately described the situation. People, toward the end of the last expansion, older people were staying in the labor force longer. And as a result, for years and years, we were seeing higher readings on participation than we expected, which was a good thing, we thought. You know, we want the U.S. The U.S. has a low participation rate compared to our peers, surprisingly, but it does. So the question is, what's this going to, and then a lot of those people retired. 3 million people left the labor force, and it tended to be older people actually retiring. And the question is, what's going to be the equilibrium once the economy is going full bore again? Labor force participation tends to lag, recovery tends to lag, unemployment recovery. So when labor markets get tight, we tend to see this. So I would just say, first of all, a lot of humility is appropriate here. We don't know what the trend labor force participation rate is, but we went through 8 years of watching labor force participation be higher than we expected, and I fully took that on board, and I think the U.S. can do much better in terms of labor force participation. So I'm not going to close my mind to the idea that we might get back to those levels.
Yeah, well, thanks for the thoughtful answer. I guess if that participation rate for those 55 and older permanently remains below the pre-pandemic levels, how might you see that impacting the time it might take the economy to get back to full employment, and what impact might that have as it relates to inflation?
Well, so if there's less labor supply, then you'll hit full employment earlier. As you know, obviously, we consider a broad range of indicators, not just unemployment, also participation, wages, and those things. But you presumably, if there's less labor supply and lower participation structurally, then you would see that in the form of higher wages and higher inflation. We'd be able to see that.
Chairman Powell, thank you. I want to get to my last question here, and that's regarding the balance sheet of the Federal Reserve. It recently eclipsed $8 trillion, which is more than double where it was before the pandemic. When, if ever, do you think the Fed's balance sheet will fall below $8 trillion? And could you describe what the risks are if the balance sheet remains at this elevated level for an extended period of time?
So we have the last cycle as an example. What we did was we slowed the pace of asset purchases, and then we froze the size of the balance sheet for a period of years. And as the economy grows relative to the balance sheet, the size of the balance sheet relative to the economy becomes smaller. So we did quite a bit of that. And then for a couple of years, we actually let the balance sheet run off and shrink. As securities matured, we stopped reinvesting them and we let the balance sheet shrink at the margin. We haven't made those kind of decisions yet, but it's a reasonable starting place to think that we might hold the balance sheet constant for some time and then perhaps allow it to shrink under $8 trillion. In the meantime, it becomes smaller as a portion of the economy, and that's the same thing as shrinking in a way.
Great. Thank you, Mr. Chairman.
Thank you, Senator Dane. Senator Van Hollen of Maryland is recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Toomey, and Mr. Chairman, welcome. I've heard the term unprecedented used to describe the jump in inflation. I think what's truly unprecedented is the number of jobs we've seen generated since President Biden took office. 3 million jobs, the highest rate of job growth of any president in United States history, as we work seriously to defeat the pandemic and as we pass the American Rescue Plan to give confidence to people in the future of the U.S. economy. I do want to dig a little deeper into the inflation issue because you've made the point clearly here today that you believe it's a temporary increase, and if you look at long-term projections, they're closer to your targets, and that's also the expectation of folks in the financial markets as well. Isn't that the case?
Yes, broadly speaking.
And it's interesting how a short period of time changes things. I'm looking at remarks you made in May 2019 when people were afraid that the inflation rate was too low and below your targets. And at that time, you made the point you thought it was transitory, and you were right. And you used a different measure of trimmed mean CPI to describe your thinking. Can you just talk a little bit about what that measure is?
Sure. One thing that people do at times like this is they chop off the tails and just look at the middle of the distribution, because sometimes the overall inflation measure can be distorted by just a couple of categories. So if you did that here, this is the Dallas trimmed mean, and the Cleveland does a version of this. It's going to show inflation that's in the low 2s because you're getting rid of that small group of categories. The risk is that you shop for whatever inflation measure that is appropriate at the moment. So we try not to do that. But clearly, trimmed mean is sending a signal that this is more idiosyncratic than broad across the economy.
Right. And isn't it the case that the increased prices of used cars rose by 10% in June alone and accounted for more than 1/3 of the entire increase in the CPI in June?
Yes, it is.
Right. So, I mean, those are the kind of anomalies you're referring to, right?
It's used cars, new cars, rental cars, it's airplane tickets, it's hotels. It's all things that have a story that's clearly related to the pandemic. At least that's what it is now.
Right. So, I think rather than rush to create alarm about inflation, I think we should all be together in focusing on important increases in job growth and wages that we're seeing. I know you said yesterday that you expect that we should be able to get back to 3.5% unemployment as we move forward. I know Secretary Yellen's talked about maybe this time next year. I am worried, and we've discussed this in the past, about persistent long-term unemployment. And if you look at the June numbers, the long-term unemployed, and these are individuals who've been jobless for more than 27 weeks or more, increased by 233,000 to 4 million total. That followed a decline in long-term unemployment in May. So my question is there any way we can get back to 3.5% unemployment if we don't get this number down when it comes to the long-term unemployed?
Well, we saw that what a really strong labor market does is it pulls those people in and also pulls people in who are on the sidelines or keeps people from leaving. So there's just so much to like about a really strong labor market. And
I agree with you, Mr. Chairman. If you look even before the pandemic, though, in February before the pandemic, 3.5% unemployment, we had over 1 million Americans who were long-term unemployed. So, yes, we hope that the growing economy will be a magnet, and I'm sure it will. It is going to bring a lot of people into the job force. I think all of us are concerned about labor force participation. I think a stronger economy will address that. But there is this group of long-term unemployed, and my concern is, as you well know, the data shows the longer you're unemployed, the harder it becomes to get back into the workforce. And then you get in at a lower wage, which stays with you throughout your career. Do you believe it's worth the Congress considering, I know this is not your domain to be specific about what, deliberate policies like wage subsidies, which we used successfully back in 2008, those kind of deliberate policies to make sure that the persistently unemployed, long-term unemployed can get back into the labor force?
I would, again, without trying to endorse anything in particular, we lag all of our peers in labor force participation now, which is not where we want to be as a country. And I do think that's a classic supply-side policy, is to try to find ways to connect people, to give them some help in connecting to the labor force, and then they need a strong job market to pull them in and keep them there. But I do think those things are worth looking at.
I appreciate that. Thank you, Mr. Chairman. Hope we'll do that.
Thank you, Senator Van Hollen. Senator Kramer of North Dakota is recognized for 5 minutes.
Thank you, Chairman Brown, Ranking Member Toomey. Thank you, Chairman Powell, for being here. First of all, let me add my voice to the chorus of people to thank you for your cool head through this process, particularly for resisting the pressures to lower rates when it wasn't necessary, so we had some room when it became very necessary. Appreciate that very much. Now, I was interested in a lot of the discussion going on. I was particularly interested in listening to your exchange with Senator Hagerty, where you used the line that I've heard you use many times when he asked a question about what Congress ought to be doing. You said, and I think this is a direct quote, "We are not in the business of giving fiscal advice to Congress either way." And again, that's similar to what you've said many times. Yesterday, thinking about this, I did a quick search engine review of the words "Fed Chair urges Congress." And this won't surprise you. And by the way, there's not a person in this room that doesn't have some sympathy over headlines that aren't quite accurate, or even quotes. But one report in May of last year says the Fed chairman asked Congress to consider more stimulus. October of last year, Jerome Powell is putting out the call to Congress, more money now. November of last year, Powell still thinks U.S. needs more stimulus for full recovery. Even in December of last year, Fed Chair Treasury urged Congress to give U.S. a stimulus bridge. In other words, you haven't always resisted the temptation to give us fiscal advice. And by the way, thank you for it. I think it was good advice. Maybe we look back and say, well, maybe we did too much. But we were in a crisis. You did what you needed to do. We did what we needed to do. And I don't think there's a lot of regret about that. Now, a number of my colleagues have pointed to what's gone on lately and what's being suggested going forward. In addition to the $3.5 trillion package, it includes a lot of tax increases, like 7 times more increase than the cuts from 2017 that built the foundation for this quick recovery, I might add. You add in the $1.9 trillion totally unpaid for earlier this year, the $0.6 trillion in new spending as part of the $1.2 trillion bipartisan package that's being discussed. It's, you get to $6 trillion plus really, really fast. What people aren't talking about is if we end up at the end of this fiscal year passing a one-year CR or something similar to a one-year continuing resolution, we're going to spend another $6.845 trillion, $3 trillion of which will be deficit spending. Deficit spending. Now, my question to you is very direct, and that's just simply, does the economy need another $6 trillion plus another $6.8 trillion spent this year to enhance the recovery? And is there not a detrimental effect to all of that, including the tax increases, when we are, in fact, in a, call it whatever you want, type of an inflationary time, but it is uncertain, and there's concern, if not alarm?
If I can answer that by saying, we did a lot of things. I did a lot of things last year that we'd never done before, and that one in particular, I had a lot of encouragement from the administration and leadership on both sides of the Hill in both parties. But I swore it off, and I do think we should go back to regular order, which is that the Fed doesn't play a role in fiscal policies. It's not a national emergency like it was at the time, and I've been trying very hard so far this year, succeeding in not getting involved in giving fiscal advice. So I'm just going to have to, whatever you do, we take it into account in our policies, but we don't come out then and comment on whether we think this is a good idea or a bad idea. Sorry.
Well, okay, I appreciate that. Maybe just one other quick question. We noticed that the Fed is continuing to pour some, or pumping some liquidity through the purchases, mortgage purchases, particularly, obviously, Fannie and Freddie. I mean, is that, do you see that as continuing to be necessary? Obviously you do, or you're doing it, but why?
So, as you know, we're looking at that right now. We're looking at, my colleagues and I on the Federal Open Market Committee are having a second meeting about that in a couple of weeks, and we're going to talk about the composition of our asset purchases and the path to beginning to reduce them. And I wouldn't want to judge that, but this is something that's very much on the table.
I might just add real quickly, with regard to climate risk that you've heard a lot about today, whether it's political or true risk, I would just want to remind my colleagues that when we assess climate risk in terms of the U.S. economy or U.S. investment, do not forget that every time we don't invest in energy or climate manufacturing issues in the United States, another country that doesn't do it as well as us is going to do it as well. And this is climate change is a global issue, so let's think about risk in a global context. Thank you, Mr. Chairman.
Thank you, Senator Kramer. I am going to go vote. Turn it. Senator Ossoff is next. A Republican, Senator Lummis, we think is coming back, or perhaps Senator Crapo, maybe, and then Senator Reid will go. But Senator Reid will chair, and Senator Ossoff is recognized for 5 minutes.
Thank you, Chairman Brown, Ranking Member Toomey. Thank you, Chairman Powell, for your service and your testimony today. Obviously, over the last 18 months, the COVID-19 pandemic has been the most significant shock to our economy and the financial system. But stepping back, what do you assess to be the most significant systemic threats to financial stability over the medium term, either limited to the U.S. or globally?
I'd have to say that the thing that worries me the most about it is really cyber risk. It's a constant concern, and we spend lots of time and resources on it. So does the private sector, but that's the one where we have a playbook for bad lending and bad risk management. We have a lot of capital in the system, but the cyber, as you see with the ransomware issues now, it's just an ongoing race really to keep up, and we haven't had to face a significant cyber event from a financial stability standpoint, and I hope we don't. But that's the thing I worry the most about.
And in terms of threats to financial stability following cyber, what next preoccupies your attention or concern?
The economy's coming out of this globally, coming out of this pandemic. So I would worry about if we don't succeed in vaccinating people all over the world, really, we're creating time and space for the development of new strains of the virus, which can be more virulent and more difficult to fight. And I worry that could undermine the economy and ultimately financial stability. The last thing I'll say is, we're at the point in the risk cycle where people are looking out 4 or 5 years and they're seeing pretty good economy. We're heading to I think a strong labor market, highest GDP in 7 years. This is the time when risk takers can begin to forget that there's a bad state of the economy out there waiting for them at some future date and take too much risk. And so from a supervisory and regulatory perspective, we're very mindful that it's a time when we need to keep people focused on risk management.
That's a great segue to my next question, which is, given the extraordinary provision of liquidity, not just since COVID-19, but over the last 15 years, how concerned are you that credit committees at major financial institutions and others allocating capital are acting with sufficient prudence, given the easy access to capital?
Financial conditions are highly accommodative. People are getting things financed, SPACs and things like that are getting done. We see Bitcoin going up in value and down in value. So at times it's felt like a somewhat frothy market, and you do worry about that. At the same time, we're very focused on the real economy. Our jobs are maximum employment and price stability, really, and also financial stability. But we've got a long way to go, so we want to be careful about tending to our main mandate while we also think about financial stability issues.
What is your level of confidence that there are not risks lurking in the non-bank financial system, hedge funds, private equity, SPACs you mentioned, given the provision of all this liquidity and the reduced visibility that regulators have into some of those institutions?
So there's lots of risk-taking going on in the non-bank financial sector. Much of it can take care of itself. Private capital can absorb losses. We know from the experience of the last crisis and the one before that there are structural aspects of the non-bank financial sector that really need need better regulation and better structures, and that's particularly money market funds, which twice have had to be bailed out in the acute phase of the crisis. I think we saw that the Treasury market really lost functionality, the most important financial market. It lost functionality significantly during the acute phase of the crisis, and we're doing a very careful analysis and thought about whether there needs to be some structural strengthening there and other aspects as well.
Turning finally to climate change. The Fed's most recent financial stability report cited climate change as a potential threat to financial stability. The National Oceanic and Atmospheric Administration, our country's foremost meteorological agency, states that impacts from climate change are happening now. They cite risks including changes to water resources, floods and water quality problems, challenges for farmers and ranchers, increases in waterborne diseases, rising sea levels that put coastal areas at greater risk. The Department of Defense identifies climate change as a critical national security threat. What is your assessment of the risk that climate change may pose to financial stability or to your dual mandate of full employment and price stability in the long run?
Well, I think it has implications for all of those things in the long run. We're very focused on the risks that individual financial institutions are taking and working with them to make sure they understand the risks they're running and can manage them and address them in their business model. More broadly, in financial stability, financial markets generally, and non-bank financial institutions, it's much the same. We know that the transition, for example, to a lower carbon economy may lead to sudden repricings of assets or entire industries, and we need to think about that carefully in advance and understand and be in a position to deal with all of that. We're doing all of that work, as are other researchers and central banks and governments around the world. There's a lot of work going on this, and it's a high priority, but a longer-term issue in terms of the financial stability. I mean, I think the manifestations of climate change are here now, but the financial stability issues are really coming.
Thank you, Chairman Powell. I yield, Mr. Chairman.
Thank you. On behalf of Chairman Brown, let me recognize Senator Loomis.
Thank you very much, Mr. Chairman, and welcome. Good to see you again. My first question, as you might guess, is about digital assets. You had testified yesterday in front of the House Financial Services Committee that one of the stronger arguments in support of a central bank digital currency was its potential to render stablecoins and virtual currencies unnecessary. But in March, you acknowledged that Bitcoin, Ethereum, and other virtual currencies are essentially a substitute for gold rather than the dollar. So I want to talk a little bit about the difference between the two. So it's pretty clear that Bitcoin, Ethereum, and other virtual currencies are investment commodities and not payment instruments. The SEC and CFTC have said as much in court cases and regulatory actions. So I think what you were trying to get at is one of the best arguments for a central bank digital currency is that stablecoins could be rendered unnecessary. But legally speaking, stablecoins and virtual currencies are not synonymous because stablecoins don't increase in value generally and are used as substitute payment instruments, whereas Bitcoin, Ethereum, and other virtual currencies are investment assets. There's research from Fidelity, Deutsche Bank, and Credit Suisse, among others, that call Bitcoin an emerging store of value. Goldman Sachs has also said the same about Ethereum. And so my question is, because stablecoins and a central bank digital currency are more synonymous with the dollar as an instrument of payment, and Bitcoin, Ethereum, and other virtual assets are more an investment commodity like gold, when you spoke to the Financial Services Committee in the House yesterday, did you mean that stablecoin would be unnecessary if we had a central bank digital currency?
You're right. But let me say, though, with cryptocurrencies, it's not that they didn't aspire to be a payment mechanism. It's that they've completely failed to become one, except for people who desire anonymity, of course, for whatever reason. So that's why I included them. But I would completely agree. Really, the question is stable coins. And my point with stablecoins was that they're like money funds, they're like bank deposits, and they're growing incredibly fast, but without appropriate regulation. And if we're going to have something that looks just like a money market fund or a bank deposit or a narrow bank, and it's growing really fast, we really ought to have appropriate regulation, and today we don't.
And I would assume, thank you for that. I would assume that you would agree that some common definitions and kind of a clear legal framework would help us understand the opportunities associated and the risks associated with financial innovation.
Yes, I can certainly agree with that.
Thank you. Thanks so much. Now I want to turn to monetary policy, and I'd like to draw your attention to this chart. Federal Reserve and Bureau of Economic Analysis M2 data shows that deposits and close substitutes held by households have generally averaged 51% of GDP from 1952 to 2021. But then data from the end of quarter one of 2021 shows that households are sitting on deposits and close substitutes of approximately 79% of GDP today. So that's roughly 28% or trillions of dollars above the historic average. So going back to 1952, there's never been a higher percentage of household deposits to GDP. Monetary policy also has been highly accommodative over the last 16 months to the tune of 32% increase in the M2 money supply. So I haven't heard anybody talking about this hidden stimulus. And when households start to spend this cash, combined with the enormous liquidity already out there, it seems there's real potential for inflation to continue to overshoot. We've already seen it this week, as the core consumer price index number was nearly double what economists had predicted. So here's my question. Is it really wise to continue to have accommodative policy when there's still trillions of household cash that will flow into the economy soon?
So this, I think the main factors driving this up are really that people have been sitting at home for a year and a half, not able to travel and go on vacation and spend money in restaurants and things like that, and also combine that with the major fiscal transfers that Congress made. So there's a lot of cash, as you know. There's a great deal of cash on household balance sheets, and that's what this is representing. Is it appropriate for us to continue accommodative policy? We think it is, but as you know, we're in the process of evaluating, when it'll be appropriate for us to taper, which is to say reduce our asset purchases. We're having a second meeting that'll address that topic directly in a couple of weeks. So, but for the time being, the other thing I'd point out is there's still a lot of unemployed people out there. And we think it's appropriate for monetary policy to remain accommodative and supportive of economic activity for now.
Thank you for your responses. Thank you, Mr. Chairman. I yield back.
Thank you, Senator. On behalf of Senator Brown, I'll recognize myself, and at the conclusion of my comments, I will yield to Senator Warnock, and by that time, I presume Senator Brown will be back to conclude the hearing. But I will ask first. So, first of all, thank you, Mr. Chairman, for your remarkable service over these many challenging months. I appreciate it very much. One of the aspects of the pandemic has been an indication of the potential for technological displacement of workers. I think we're all now familiar with Zoom. In fact, it's a blessing and a curse simultaneously. But as you look forward, how are you factoring in this notion of technological displacement in terms of the workforce and employment?
We began hearing very early in the recovery period that companies were looking at ways to use technology really more aggressively in their business models. And a lot of the people who lost their jobs during the pandemic, of course, were people in service industries, relatively low-paid, public, customer-facing businesses, hotels, travel, entertainment, things like that. So I think we're going to see that, and that's, by the way, the technology coming into these industries has been a trend. I think we're going to see that accelerated, and you'll see more technology and maybe fewer people. And I think the implication of that is that we need to work as a society to make sure that people find their way back into the labor force, even if they can't find their way back into their old job.
And what I think that does is stress the need for improving human capital so that they can be competitive in jobs that they might otherwise not be. That's education, that's a lot of the things that, and I know you don't comment on fiscal affairs, but a lot of the aspects of the President's American Family Plan, preschool education, 2 years post-secondary education, significant job training, et cetera. But just in terms of the future, we're going to have to make those investments. Otherwise, my sense would be we're going to have a lot of people who want to work, but whose skills are not up to the new technological opportunities. Is that fair?
It may well be, and that's been a long-run trend. If people can keep up with evolving technology, that lifts all incomes and lifts their incomes, and if they can't, they tend to fall behind.
Let me change subject slightly here. Labor force participation. One of the other illustrations from the pandemic was that many, particularly women, were unable to continue in the workforce because of their childcare responsibilities. Have you and the Fed looked at this factor as one of those inhibiting issues for labor force participation? And is it a factor?
It is a factor. If you include broadly caretaking, it's a big factor. Yep. If you just include children and schools being closed and caretaking at home and that kind of thing, it's still a medium-sized factor that's holding back participation.
So if there is reasonable and available daycare, that should contribute to increased labor force participation.
So I think it's daycare coming back, reopening, being available. It's also schools reopening in the fall, which should help as well.
Right. We've all, I think all of us touched one way or the other on the inflation issues, and some of these seem to be sort of one-off effects of the pandemic. Lumber went out of sight because people were sitting home, decided they redecorate and renovate. Lumber futures are down now, I believe, so we can see that leveling off, hopefully, in the future of prices. There was a chip shortage, and which caused new cars to be expensive, which drove up the price of used cars. My sense is, your view is that these are transitory effects that are somewhat related to the pandemic or other causes, but they don't represent a trend. Is that fair?
Yes, we can identify a half dozen things just like that, and they look very much like temporary factors that will abate over time. What we don't know is, are there other things coming along to replace them? We do hear of pressures across the economy. We don't really see prices moving up broadly across the economy at this point, but we're watching carefully for that.
And just a final point, in echoing something Senator Ossoff said, climate change every day becomes much more pronounced and much more obvious to all of us, and the impact on the economy is something that I think is not transitory. It will be with us. Simple things like food, when there's no water for irrigation, more complicated things like displacement of homes because of rising waters or a lack of water rather. And I'm pleased to see that you're beginning to focus in on that. My sense is, though, every day there'll be another challenge, and it'll be more. The news will be more upsetting. Let me put it that way. I hope that's a fair comment.
Thanks.
Thank you, Mr. Chairman.
Thank you, Senator Reid. Thank you for presiding. Senator Warnock from Georgia is recognized for 5 minutes.
Thank you so much, Chairman Brown, and thank you, Chairman Powell. I'm a strong advocate for working families and successfully pushed, along with Senator Brown and Senator Booker, Senator Bennett, and others, expansion of the vital child tax credit program in the American Rescue Plan. The expanded child tax credit essentially provides a tax cut for middle-class families, cutting childhood poverty nearly in half nationwide, and is generally available to most American families with children, including families with little to no income. Today is a great day because many of them will see that tax cut hit their bank accounts today, and I'm happy to see hardworking families across Georgia and across the country see the benefit of this to help with the rising costs of raising our children. In my home state of Georgia alone, more than 1.2 million families will receive these payments, providing much-needed relief to over 2 million children across the state. In previous remarks, Chairman Powell, you stated that, quote, the widespread vaccinations, along with unprecedented fiscal policy actions, are providing strong support to the economic recovery. With families now beginning to receive their child tax credit payments today, how does direct financial support to families help sustain an ongoing economic recovery?
Well, of course, we try not to comment on fiscal policy measures, particularly such as the one you've mentioned, but I will just say generally in the recovery from the pandemic that fiscal policy really did step in strongly and support people in their time of need, and I think the record will show that.
Thank you. I have another quick question about a housing bill I'm currently working on, which I hope will be a bipartisan bill. One of the other challenges that I've worked hard to address is the widening racial wealth gap in our country. A wealth gap that has been further exacerbated during the pandemic. In particular, I've focused on the persistent disparities that exist in the undervaluation of black and brown homeowners within our appraisal market, which, as we all know, is a key contributor to creating generational and middle-class wealth. Most people's wealth is in their homes. This is directly tied to the value of their homes and thus their ability to pass on wealth to their children. I'm glad to see the Biden administration, the Fed, and other federal banking and housing agencies taking action, as well as banks, credit unions, the appraisal industry, and other stakeholders leaning in collectively together to help solve this longstanding issue. Now it seems to me it's time for Congress to join the effort. Chairman Powell, do you agree that addressing racial disparities within the appraisal market can help our economy and help close the racial wealth gap?
Well, I do think that there's no place for racial discrimination in our banking sector, in our housing sector, certainly in the appraisal. And there's a big focus now on appraisals, as you point out. And we will use the authorities that we have in supervising institutions, enforcing CRA to try to eliminate that kind of discrimination.
Do you think it will help close the racial wealth gap?
I think over time, I think a lot of the racial wealth gap is traceable to housing, as you point out. So that should be the outcome.
Thank you. In April, our colleagues on the House Financial Services Committee unanimously passed the Real Estate Valuation Fairness and Improvement Act on a bipartisan voice vote. Not only would this bill be a great step in improving appraisal practices and mitigating racial bias, it seems to me it would also help increase and diversify the appraiser pipeline and increase the number of trained appraisers in rural communities. And so I'm planning to introduce this legislation along with Senator Klobuchar and Chairman Brown here in the Senate, and I hope to do so with a few of my colleagues from across the aisle because I believe we can work together in a bipartisan manner to tackle this critical issue that impacts not only these homeowners, but impacts the economy as we close the racial gap. We all have a stake in that. One final question on a topic that I'm also very interested in. Chairman Powell, as you know, the Community Reinvestment Act addresses how banks must meet the credit and capital needs of the communities they serve. Back in May, I asked your colleague, Mr. Quarles, about the Fed's intention to issue a joint rule along with the OCC and FDIC, and he expressed that it was the Fed's objective to work with the OCC and the FDIC to issue a joint CRA rule that protects and strengthens our most vulnerable communities. Could you please provide us with an update on the status of this CRA rulemaking?
I'd be glad to. We are working through the process of reviewing a really quite extensive group of comments and now engaging with the OCC to go forward and try to sort through that and come out with appropriate changes to what we proposed. I can't speak exactly to the FDIC. I think they're considering whether to take part in this process. We, of course, would really like to get the three agencies together on a CRA proposal, and I'm very optimistic. There's a lot of work left to do, but I'm very optimistic that the work product will be a very good one.
Thank you so much.
Thank you, Senator Warnock. I understand the chair can't comment on the immense importance of child tax credit, but I can, and I thank Senator Warnock for bringing it up and thank him for his leadership, even in his first 6 months in the Senate, on an issue that's going to make a huge difference to 39 million families, 52 million children, 92% of children in my state will benefit from it. We don't quite have everybody getting checks today or direct deposits today, tomorrow, and Saturday. We encourage people to go to taxcredit.gov, that people that have not, that are eligible, and that's, as I said, 92% of the children in my state. So, Senator Warnock, thank you for your work on that. Chair Powell, thank you for being witness today and providing testimony for senators who wish to submit questions for the record. Those questions are due 1 week from today. On Thursday, July 22nd, Chair Powell, if you would, you have 45 days to respond to any questions. Thank you again. With that, the hearing's adjourned.
Thank you.
Thank you, Jay.